Bay Area investors are now pivoting to 3 different asset classes. Let me give the details, and you can set up a call to discuss all the investment strategies that will fit your needs, your profile, and your risk approach, everything. So, I'm going to make a controversial statement here. If you like it, great. If you don't like it, I will highly recommend you dig into the data and see where these numbers come from. Are they true? Do they make sense? And whatnot. So, I've been looking at a lot of data, a lot of websites. Some are easy to navigate, some will give you a very easy way to find the numbers. The typical average Bay Area appreciation is over 6%. I'm not going to say 8, 10, 9 because that depends on the areas, the neighborhoods, the pockets where most of the money is pouring and all of that. So the minimum that I have seen typically going in is about 6+%. And I said this is controversial because most people don't want to believe that money comes that easily and appreciation happens that easily. The average US appreciation though is 4.5%. So get this, 1.5% difference minimum over an average US property in terms of appreciation. And if you go and look at the compounded numbers, you will see a very different picture in the end result that you will be seeing when you see the appreciation over 30 years. So most of the big and smart money that comes into Bay Area, they come because they know this math, that they are going to nail down a substantial chunk in appreciation. So there are 2 classes of investors. Investors that want that want money coming in cash today. That is why I was using the word real. And there are investors that play to build long-term wealth and they want to avoid taxes. So these people, they don't chase just cash returns because they are already making high income, and which is a very typical profile of a Bay Area investor. Investors that come to Bay Area, they come because they have substantial cash sitting around, they have substantial stocks sitting around, and they fear that the stock market being as volatile as it is, where do they park their money? And so, in favor of how to park that money for keeping it in a manageable, sane way, they start pivoting into real estate assets. And so the other principle that I'm going to give you here is that the real estate appreciation, just like the stock market. So in the stock market, we typically get dividends and or interest on bonds as regular income and the growth in the stock price. So the stock keeps growing. So the total return that we get from the stock market is a combination of the dividend or interest and the growth in the underlying asset value. Now, comparing the same thing with real estate, we get rental income, and if you live in the property yourself, you save that much rent and pocket that rent. So you're not paying the rent to somebody else, you're paying it to yourself, you're covering the costs and you're saving that money and you're capturing appreciation. So if I can make this very clear, both stock market and real estate, we have similar nature of returns coming from these. Now, that's where the similarity stops. The difference in the stock market, real estate is that this total return is a sum of appreciation and the rent payment that you get on this. So let's assume that the total return per year is 8% or 10%. Now, why do I say 10%? I am saying in the Bay Area you get about 6% in appreciation and about 3 to 4% in rental income from properties. Now, what happens is that if you go to Texas or Florida or some inside states, I have seen Flint, Michigan, where in the last 20 years there has been a degrowth of 5%. Whereas here in the Bay Area, the appreciation average for the South Bay market has been 248% over 20 years. This is from data. If you want, reach out to me. I'll share the sources and you can play with the data. I'm pretty sure with ChatGPT or all the AI that is around, you will be able to figure out where to find that data by yourself. But this is what happens in the Bay Area. So about 6% or upwards of appreciation and about 3 to 4% of income. You go outside the Bay Area and this profile changes. The appreciation is 4 or below and the rental income is about 5 or 6%. So yes, both of these will return roughly the same annualized return, but the kind of guarantee of the appreciation per year and the high appreciation in the Bay Area versus the low appreciation in out of the Bay Area is what gives big money a solid foundation to continue to build immense wealth. And they also focus on moving their current earned income and pushing that earned income into capital gains. Guess what they are trying to do? They are trying to take the earned income is in the 40 to 50% tax bracket, 42 to 50% tax bracket, whereas capital gains are 20 to 30% in tax bracket. So what they do is they make all this big appreciation and they just book, if at all, they book it as a capital gains tax, which is at least 10% cheaper than the earned income tax. So that's one. So what are the asset classes that the big money is chasing at this point in time? So number one, they are chasing all the big communities because we are hearing about 5 days back to work, return to office. They are chasing big rental communities because they expect a substantial move from the peripheries and out of state people to come back and start working here. And more so with the AI pressure on the jobs, they are going to look at being very close to high salary employment centers. So the luxury, high growth, multifamily or mixed use properties is one big target. The number two area that I have been recommending for a lot of people is residential investment properties. So duplexes to fourplexes. Feel free to talk to me in detail about it. So these duplexes to fourplexes, they give a very high rent ratio, about 4 to 5%, and the appreciation is the same as the Bay Area appreciation. So you are doing 1% or 2% better than a typical property. And if you look at it from out of state perspective, you are like 3 to 4% lower when you invest in the similar segment out of the state. And the third, for those that are just putting their feet in the water and trying to get their feet wet or feel the residential investment property environment, is new home build, single family in the lower budget sure to reach out to me and I'll give you the details on what areas to look for, how to compare, how to contrast, and how to analyze these numbers so that they will work for you. So look at this, watch this video multiple times, try to make sense of what I am saying. I can definitely give you the numbers, and if I get feedback from you on this video, I'll definitely make further videos explaining each of the concept that I'm employing in this video so that I see what my audience is asking and I will build it up from there. Thanks for watching. See you on my next one.